So for today, I'm going to talk about monitoring your positions, how to set that up, how to do that, adjusting your positions, closing and rolling those positions, and redeploying capital. Okay, for starters, I think, this is going to sound a little beginner-like, but you wouldn't believe how many questions we get about practical watch lists and actionable watch lists. In fact, until we've kind of re-engineered the way people look at futures and equities, I don't think most people understand or I don't think most people that trade really understand the role of kind of like where your eyes should focus on. So the first thing when building when looking at your platform and deciding, hey, how am I going to manage my positions? Well, I think it's super important to build a watch list. Every platform has a watch list on it. The problem that most people make with watch lists are they follow the stocks that they like. And on a day like today, you might find some NASDAQ stocks lower, you might find some other stocks higher, but you're not really sure what's going on. So watch lists should start with the front month index futures in descending order. So, and I know I'm being very specific here and very particular, but you have to understand what drives markets. And what moves markets are the index futures. That's the largest, most liquid pool of liquidity in the world. And when we say it's the most capital efficient pool of liquidity. So big money will flow into institutional money, retail money, whatever it is. It will flow into index futures, which will move the market and the stocks will follow. So on your watch list, and also futures are 24/5. So from Sunday night at 5 o'clock till Friday night, basically at 5 o'clock, we're talking about the futures markets are open. And what's important about that is it gives you a really good idea of what is driving the equity markets. So what I do is I start with, for example, ES, which are the S&P 500s, NQ, which are the NASDAQ, YM, which is the Dow, or RTY, which is the Russell. Start with those four and then list other liquid futures below that. That's how you start to build a watch list. And then following that, you want to put all your liquid equities. Now, liquid equities mean that the options are probably liquid. Sometimes you'll find an option marketplace that's super liquid when the equity itself or the index isn't really that liquid, but it's rare. So what I do is following in descending order, following my futures, okay, I will list them in groups. Like, I will put gold, silver next to gold. I'll put 10-year notes next to bonds, that kind of thing. But then following that, I will list equities, most liquid equities first. Like you'll probably start off with, the top 7 or 8 most actively traded underlyings, and then all the way down to, let's call it the first, I don't know, it could be 75 to 200. It doesn't really matter. On a separate tab, you should also have your positions. If you're on a platform that doesn't support watch lists that include, that give you the flexibility to set these up and have futures followed by equities, and then also a separate one with positions, then you really need to consider a different trading platform, because it's almost impossible in 2024 to trade without understanding what the futures markets are doing and understanding, how the option markets relate to the futures markets, being able to follow it all make eye contact with that, and then also being able to flip quickly to your position, to a list of all your positions. And then what's super important, and what's something that I'm excited about the way technology has developed since the early days of, when we were building Thinkorswim to where we are today with Tasty. We've come a long way, and we now can take our watch lists and sort watch lists by just, pretty much 50 or 60 different things. And if you learn to sort by IVR and liquidity, it really helps. And what I posted here on the first slide was just an example of sorting by IVR and liquidity. So for example, these are 7 different stocks, which I have some positions in: Boeing, Meta, SMCI, Google, AMD, NVIDIA, and MU. But what I did was I sorted these not in alphabetical order or anything like that, but I sorted these by IV rank. And then I also included the next column over by liquidity. So you can see like some have a 2-star liquidity, some have 3-star, some have 4-star liquidity. Google and AMD with 4-star liquidity. I would argue right now NVIDIA easily has 4-star liquidity, but some like SMCI might have 2-star liquidity. What's interesting about this is on different platforms now, you can sort by liquidity if you want, but I always sort by IV rank because I want to know where implied volatility is relative to itself when I am A, holding positions, or B, putting on new positions. Because today's segment is on managing existing positions and managing your portfolio. What I want to know is in my list of open positions, which has the highest implied volatility rank, because those are the ones I'm going to roll forward. So if I looked at this, for example, I look at Boeing, I say, okay, I'm definitely rolling that forward. Now, all of these are high. So they're all plus 50. So all of these I'm going to roll forward. But sometimes you'll find one where the IV rank is in single digits. Like you might have a SPY position on where the IV rank is 8, or you might have another position on like bonds where the IV rank is 1. In those cases, you're probably not going to roll those positions forward. You might close those positions. Being able to set your watch list up and to be able to sort it by IVR lets you immediately know which stocks in your portfolio you are going to roll and which stocks you are going to close. And, it can also give you an idea based on liquidity. It can also give you an idea based on P&L, but IV rank is the simplest and most consistent. And we are fighting today for consistency. This is all about consistency. Now, a lot of these slides are a little heavy because I included a ton of information on these, especially the first few. So just bear with me. If it's new to you or it's a little difficult, don't worry. Everything we do is designed to be challenging. But I think once you see it enough and there's enough repetition, it will make a lot of sense. So the next thing I want when you're deciding how you're going to manage your position, you've got to do a quick scan of the individual Greeks, whether you have on, and your P&Ls, whether you have on 1 position, 5 positions, 10 positions, or 80 positions. It doesn't matter. So what we do is we use native Greeks. Those are non-beta weighted for equity option positions, and our equity index positions. Okay, I'll get to futures in 1 second. But we use native Greeks. That means non-beta weighted for equity options indexes. This is not our total. This is just our individual positions. Now, the reason I'm telling you this is because people get very confused when they beta weight everything to the SPY, and they get very confused when individual positions are beta weighted to the SPY because it looks a little weird. But that's why we use the native Greeks, non-beta weighted for equity options, ETFs, and indexes. If possible, and this is not available on every platform, but it is available on Tasty, we use ETF Greeks for all futures positions and all futures options positions. So we allow you to compare apples to apples. I feel this was a very important adjustment we made to the platform. And what it allows you to do is have a position on in NVIDIA, have a position on in IBM, have a position on, for example, let's just say in Reddit, and compare that to a position in the S&Ps and a position in crude oil, because everything is set to an equity equivalent. Because futures on their own get very complicated when you take a futures Greek because it has different multipliers. So if you want to normalize futures and make them a part of your portfolio, which I think is incredibly important, for capital efficiency, which is the main thing, but it's capital efficiency and also because they are non-correlated. So what we'd love you to do is to include futures and futures options positions along with your equity positions. But in order to compare apples to apples, what we do is we normalize everything by using native non-beta weighted Greeks for individual equities. And then for futures, we convert everything to their equity equivalent. So for example, ES would be converted to SPY, but as you see below, crude oil is converted to USO. Because then we can convert USO to SPY in the big picture, and it's much simpler. Now for P&L, and this is what also confused a lot of people, and I know I'm kind of going over stuff that you're like thinking, wow, I've never heard this before because nobody really covers this stuff. But for P&L, you should default to a daily P&L for your individual underlyings. Your overall totals, you're always going to use daily P&L, but for individual underlyings, I also use daily P&L. A lot of people look at open P&L And a lot of people look at different other kinds of P&L, like could be individual position P&L, stuff like that. What you should look at is daily P&L for the individual positions, daily P&L for individual underlines, because it quickly tells you if a position you have on is out of whack, meaning the deltas are too far off because you're losing more money than you should, or you're making more money, whatever it is. But if you have a P&L number that looks out of whack compared to everything else, then you'll know it immediately by looking at your P&L. You can also tell by looking at your Greeks and your delta and maybe your theta, but your delta for sure. But your P&L will confirm everything. It gives you kind of that instant confirmation. Also, you need to develop consistent, comfortable guidelines for managing your daily risk, because some people will look at it all day long. Some people will log on 10 times a day. Some people look at it once a day. Some people look at it once a week. And whatever that is, okay, you have to be consistent and you have to have guidelines and manageable positions that fit within that. On the right-hand side of this page, you see I put a couple of symbols. Coinbase, for example, my P&L, let's just say today is $125 plus. And the position delta, it's an individual position delta. Those are coin deltas. Those are not converted to SPY, is 15 long 15 deltas. In the ES, my P&L is down $50. Now, those converted to SPY equals 30 SPY deltas, not ES deltas, but SPY deltas. CL, which is crude oil, I converted those with a plus 100 P&L. I converted those to USO deltas to make it simple because you understand that. And NVIDIA, the same thing, to 35 individual NVIDIA deltas. Now, you'll see what we do with those in a second, but this gives you some background for developing. Again, first thing I want to do is make sure you do the watch list right. Second thing, make sure you set up your Greeks right and you're looking at the right thing, which is your daily P&L. And everything is set up and converted to what it should look like so that you are comparing apples to apples. So on the next slide, we're going to now start looking at your overall account risk, because you don't know what to monitor in your positions until you know how your overall account risk is looking and how you're doing. So here's where we combine all the position Greeks and we beta weight everything to the SPY. Now, could you beta weight to the ES or the MES, or could you beta weight to the SPX? And the answer is yes, but we don't. We don't for consistency. We don't because otherwise people get really confused. And when people say, hey, my position is X or my position is Y, it's because everybody's been beta weighted to different things. So to simplify everything, we just beta weight everything to the SPY. It normalizes everything. It commoditizes everything. But you need to know the relationship between the SPY and the SPX. The SPY is 1/10 the size of the SPX. You need to know the relationship between the SPY and ES. The ES is 1/2 the size of the SPX, so the ES is 1/5 the size. The ES is 5 times the size of SPY, and the MES is 1/10 the size of the ES. Once you understand those, they're all the same product. So before we go off and think, oh my God, these are all different. No, they're not. They're all the same product. The SPY and the SPX, I mean, they all have their little nuances. They all might have a different, like one has dividends, one doesn't, one has the carry cost built in, one doesn't, one has a different kind of settlement than the other one, all that kind of stuff. But the reality is they're all the same. They're all the S&P 500. And once you understand that the SPX is 10 times the size of SPY, the ES is 5 times the size of the SPY, and the MES is 1/10 the size of the ES, or the equivalent, MES is the equivalent of 50 shares of SPY. So 2 MES equal 1 SPY. That allows you to normalize your portfolio risk because you can convert it into anything you want. Then what we do is we look at our theta number. We're not going to get into all the Greeks. We're just going to look at delta because you have your beta weighted deltas now. Everything is beta weighted to the SPY. And then we're going to look and we're going to see and we're going to understand a reasonable daily theta to net lick ratio. You can't manage a portfolio unless you know what you're looking for. So I'm going to get into that in 1 second. And then also, we want to make sure that your deltas are in line with your marketplace assumptions. So for example, if you are bullish and you are short deltas, your deltas are not in line with your marketplace assumption. If you are bearish and you are long deltas, your deltas are not in line with your marketplace assumption. So what you want to do is make sure your deltas are in line with your marketplace assumptions, and then make sure that your daily theta to your net lick, not to your buying power, not to something else, but to your net lick, because that's the easiest way to do it and to make it consistent, is going to be some reasonable number. What is a reasonable number? Well, it's hard to tell based on different account sizes, but what we've come up with in all our modeling is that the total portfolio theta divided by net lick or relative to net lick should be 1/10 to 1/3 or 10 to 30 basis points of your net lick. Okay, so if you're at 1%, if your net lick, for example, is $100,000 and you have 100,000 and you have $1,000 of daily decay, you have way too big a position. But if you have $200 of daily decay on a $100,000 position, you're right dead smack in the middle of where we think you should be. Now, again, these are generalizations, but this comes from 13 years worth of research. So we feel pretty confident in our numbers and all the stuff that we study. We're going to talk a little bit later about what your expectations should be around that. But from 1/10 to 1/3 is kind of a reasonable theta to net lick expectation or where you should be. And the last piece here, be mechanical. Take a disciplined approach to managing your positions. Like, don't overthink this. Don't say, oh, this stock's down, so I'm not going to adjust my position because I think it's going to rally back up. That's how you get in a lot of trouble. Or this stock's up and I think it's going to go back down, so I'm not going to roll up my puts or do whatever. That's how you get in trouble. So don't do that. Just be mechanical. You have to take a disciplined approach and you have to kind of clear your head. But you always need to know your next step. So one of the keys to managing a portfolio is knowing what you're going to do next. Don't sit there and think, oh man, let me go back and rewatch this video. Let me go back and rewatch this webinar. You need to know what your next step is. You need to know based on what strike you already have, what your next strike is. You need to know based on what expiration you're in. Are you going to stay in that same expiration? Are you going to roll to another expiration? Our default adjustment, and you've heard me say this many times before, our default adjustment is always earlier is better. Earlier is better. There is never a time when later is better. Now, of course, sometimes, I shouldn't say never, because sometimes if you wait, sure, you can get lucky, things like that. But the default should always be, if you're undecided, earlier is better. And assume you will meet risk expectations or reduce, or you have to reduce your position size. Now, down below, what we did is we put just together a little example showing what happens when you manage early versus what happens when you hold to expiration. And you can see the pop is higher, a little bit higher, 1 or 2% when you hold to expiration. But the average daily P&L is actually higher when you manage your trades early, and your P&L volatility is 1/3. And your CVAR, which is your outlier risk, drops by 2/3. What do we care about when we're trading and managing a portfolio? We care about our outlier risk. We care about our 2 standard deviation risk, which is basically what your CVAR is. That's conditional value at risk. We care about the volatility of your portfolio, which is how big are your intraday swings. If you can reduce your intraday swings by 2/3 and your outlier risk by 2/3, you manage early and increase your daily P&L. You manage early. That's it. Case closed. There is no other argument to be made here for this. I'm going to keep moving ahead so I keep us on pace. So the next piece, and again, if you have any questions, I'm Tom at tastylive.com, and there are 3 people on answering questions today, and I'll give you some other information at the end of the event. Okay, the next piece is called adjusting your positions, right? We're going to adjust positions. So this is where sometimes it gets a little confusing. And listen, this is why we're doing a 2-hour and 45-minute show with 6 different speakers. And the 6 speakers are Nikki Batista, Mike Butler, Katie McGurgle, Jamal Chandler, myself, and Pete Momad. So this is like, this is as good as we've got. So I think, you're going to get lots of different perspectives. And, I would do my best to get out and make it to one of these events. The first thing, don't forget the 3 R's. Roll up or down the untested side to reduce delta. So when you're going through your positions, you look, the market just opened, and you're looking at your positions, and you see that your deltas are a little out of whack in one underlying. Like you think you should be flat, but now all of a sudden you're short 200 deltas. Then what you're going to do is, and assuming you have a put and call position on, you're going to take that put position, whether it's a spread or whether it's a naked put, and you're going to roll it up. We call that rolling up the untested side. The tested side is the side that's being challenged, that's creating the deltas, but you're not going to touch that. You're only going to touch the untested side. If we're going down and you're picking up too many long deltas, you're going to take your call side and roll your call side down. We call that rolling down. The next thing we do is if we get a little bit too close after a couple of rolls, we call this recentering, which is done to reduce delta and to lower your gamma risk. What that is you buy the guts. That's the 2 nearest to at the money strikes. and then you buy those back in a single click, you sell out the wings. If your platform doesn't support that functionality in a single click, change your platform, because that's old technology that's not even viable in 2024. And the next thing is rolling out in time. So rolling out in time means going from the current month to the next month. Now, all of these apply to listed options, ETFs, indexes, futures options. Okay, same thing. There is no difference if you're trading crude oil, ES options, NQ options, if you're trading natural gas options, if you're trading copper options, or if you're trading soybeans or bonds or note options. They're all the same thing. You roll up or down the untested side, you recenter with one click, buy the guts and sell the wings, or you roll out in time. We call that calendarizing the trade. So you move the trade out to the next cycle. In the futures world, we call it moving it to the active month. In the listed world, we call it calendarizing the trade. That reduces your risk by about 30%. Calendarizing a trade reduces risk by 30%. So again, the 3 R's: rolling up or down the untested side, recentering, and then rolling out in time. And remember the rules of thumb. Always get comfortable doing this early, and always be comfortable taking profits, and do not add to losing positions. One of the things we have egos, and our egos get in the way a lot. And our egos sometimes tell us, hey, you know what? I love this position, but I just can't believe it's going against me, so I'm going to do more. Unless you've done it really small the first time and you have a lot more room to go, don't add to losing positions. You'll hang around this business forever if you don't add to losing positions. As soon as you start adding to losing positions, it's over, because you can't recover from that. So get comfortable taking profits, manage early, don't add to losing positions, and don't forget the 3 R's. So the next piece is, don't personalize the mechanics. What that means is, and this is a new kind of saying for us, stay disciplined and consistent, honor the research, honor the discussions that we're having today, at least trust them. I shouldn't say honor, I should have said trust it. Well, next time we say is trust the research. But the reason for that is because, again, we have these egos. We all have a very similar personality. Traders have this kind of alpha-like personality, and it makes us pig-headed. And you must stay consistent, and you must trust the research. So if the suggestion is, hey, roll up the untested side, roll up the untested side. If it's roll down the untested side, roll down the untested side. No legging. Okay, we generally don't leg. I mean, if you leg 1 time out of 10, fine. If you leg 1 time out of 20, 1 time out of 100, fine. I don't care. Of course, we don't care. But if you get in the habit of starting to leg every trade, you're dead meat. It's not going to work. And don't get cute. Okay, that means don't say, okay, I'll do this first and I'll leg into this side, or I'll do this and that. Like, this is not, you don't get paid for being cute, and nobody cares how if you saved a penny or something. So we call that no hero stuff. Change the word, the word stuff. I usually wasn't that nice. I changed it to a nice word. So don't get cute and no hero stuff. And we don't leg. And then remember, strategic optimization works. Trust the research. The reason I do this after all these years, decades, whatever it is because I want my legacy to be that we have created a platform of strategic mechanics, of strategic optimization that allows individual investors, self-directed traders, to compete with anybody, anytime, in any marketplace. The world of open outcry, gone. The world of traditional, quote, professional traders, gone. Yeah, sure, there's high frequency machines and everything else. I don't care about that. The world of self-directed investing, self-directed trading, it's all about strategic optimization. You must optimize your know-how. That is your true differentiator. So trust the research. So the next thing is to get comfortable being counterintuitive. Okay, that's why we do not adjust the tested side. That's why we focus on the untested side, because it's counterintuitive. We focus on capital efficiency, not always what seems like maybe the best potential move, but the most capital efficient move. So you're not throwing in good money after bad. We also always focus, and this is really important, when you are managing your positions and you're managing your portfolio, we focus on increasing the credits and lowering delta whenever it's possible. Like, I know positions go against us. I get it. Trust me, I've had millions of losing positions, literally millions of losing positions. So I get this. Increase credits whenever you can, which reduces risk, and lower delta when you can. And then don't add money or contracts to trades that are not working. If something's not working, okay, it's not working. It doesn't mean you have to close it. You can stay in, you can fight the good fight. You can stay in, you can battle to the bitter end, but you're not going to add money to the trade, which is you do that by increasing credits, not paying debits, and you do that by lowering delta as much as you can. Sometimes the stock wins. Sometimes trades don't work. So focus on capital efficiency. Be comfortable being counterintuitive. Try not to adjust the tested side ever. Now, here's a nice little slide here. It shows that we're looking at short puts, and we did it in the SPY and the ES. And this is what capital efficiency is all about. Now, I'm never going to tell you, hey, just trade SPY or just trade ES. We trade it all. We love the fact that this event's being sponsored by both the CME, which is our primary futures exchange, and the CBOE, which is our primary option exchange, is because everybody has certain benefits. There are great products at both exchanges. Everybody has different benefits. In the case of futures options, it's about capital efficiency. You can see here, for the same amount of money, you can make almost 7 times as much money. So for the same $7,000 putting up, 52 days in SPY or 63 days in the ES, there is $226 in max profit versus $1,400 in max profit. That's one of the advantages of understanding capital efficiency. These are the same products. Does that mean we only trade ES options? Of course not. We trade SPY all the time for lots of different reasons. But I'm just showing you that is what we call nuanced know-how. That is understanding that your max profit could be as much as 6 times greater. That's what we talk about with capital efficiency. Let's go to the next slide. Oops, sorry, here we go. So I call this do the right thing. And do the right thing is understanding that sometimes the stock wins. Sometimes you do everything right. Everything freaking right. You made the right adjustments, you rolled out at all the right times, you neutralized your delta, and you know what? That damn stock won. That damn future won. That commodity won. You know what? That ETF won. That index won. Sometimes they win. They got to win. Everybody's got to get their wins in there, okay? You have to do the right thing. You have to make the painful, defensive, individual delta adjustments. I think I know better than anybody when I'm short something and a stock's going up, for me to make a defensive delta adjustment, which means to roll up puts, is painful. But I've done it enough times to know, hey, that is just the nature of this game. Do not be afraid, on the other hand, to make offensive adjustments. You have a good position on. The IV rank is super high. You do not want to take the position off. You want to make an offensive adjustment by, for example, rolling down the calls. You want to make an offensive adjustment by rolling out to the next month and keeping the position on. There is absolutely, on a position that you have going your way, there is absolutely nothing wrong with making an offensive adjustment. Now, here's the key to this, though. Be careful when trying to hedge, because most people don't realize this, and people get really confused by the term hedge. Hedging is extremely difficult. Hedging is something I rarely talk about, because hedging, you pay a massive premium for hedging. Hedging is like an insurance policy, and you pay a very rich premium for insurance, which doesn't come into play very often. So be careful, be conservative about your hedges. If you're hedging something offensively, go for it. I'm totally fine with that. But if you're hedging something defensively, be careful, okay? Because you're probably going to overpay. So again, just a quick little reminder here. Sometimes the stock wins. Just get that through your head. Make the painful defensive individual delta adjustments. It's something every trader has to do. Don't be afraid to make offensive adjustments when you feel like, hey, you're in a strong position and the position is going your way. And be careful when trying to hedge. Be reluctant to hedge unless you really need to. All right, The next segment, and I'm moving along at a fast pace, and I hope you all are enjoying this. I hope you're all getting a lot out of this. Like I said, I just finished writing this past weekend. So none of this I've ever covered before in this kind of a webinar. So it's all new, and I think it's going to be really valuable. And then we're doing the bigger series all about this. I'm calling this segment closing and rolling. So when you have a position on and you're trying to decide, should I close the position? Should I roll the position? Should I roll it out to the next month or should I close it? What do I do at 21 DT? What do I do? Closing and rolling. Okay, so first of all, why close a position? So let's say you're at the optimal point in the decay curve, which means you have all the factors working for you. That's why you close. Let's say you've made the most on a daily basis of what you can make. And now the risk reward is going to flip-flop a little bit, and you're going to take more risk for less reward. Why close? The implied volatility rank, which when you put the position on was quite high, is now low because the IVR has dropped, because the underlying has either moved or it did what it was going to do or it had its earnings, whatever it was. So the IVR has dropped, so it's no longer an attractive play. Why close? It's a better use of capital to redeploy it somewhere else, because for whatever reason, it's just an inefficient use of capital. For example, I'm using SPY, now I can use ES or MES, whatever it is. Or I'm using USO, now I can use CL for options. There's just a better use of capital somewhere else. Or it's a different underlying altogether. I'm using CL options, I want to go to natural gas. I'm using bond options, I want to go to notes. I'm using IBM options, I want to go to Qualcomm, whatever it is. And then lastly, why close? Because the underlying is no longer part of your current assumption. You were bearish, now you're bullish. You were bearish, now you're neutral. You were bullish, now you're neutral. Okay? So, or the underlying has reached whatever your target was. What is your target? Well, it should be at the expected move. So when you put a position on, you know the expected move is $10. If the underlying moves $10, then you have to reevaluate. Hey, it went to the expected move. I should take my profits. So the next piece I wrote was about why roll. Give yourself time to be right. That's why we roll. We extend duration. We're always right, but sometimes we're like super early, like years, days, months, weeks, whatever it is. But you roll because you give yourself time to be right. We call that extending duration. Rolling is the strongest defense without adding more capital to a position. Rolling reduces your risk, buys time, and doesn't require that you add more capital. That's why you roll. We also roll because it reduces the volatility of your portfolio by as much as a third. So when your portfolio, let's say, has $100 of risk a day, if you roll forward, you reduce that risk because you're adding duration by as much as $30 or as much as 30%. And then rolling, and this is the real key here, it virtually eliminates all outlier risk. Can't eliminate, okay, I'll take out the word virtually. It eliminates most of your outlier risk. In the case of the SPY, almost all of it, but in the case of individual equities, a lot of it. As you can see here, when we put a little example at the bottom, these are 20 delta strangles in the SPY. The win rates are about the same. The win rates never change, but the difference is that you make more money. And when you have 20 delta strangles, well, this actually they didn't put probably the best numbers in here for you to see, but the generally speaking, your outlier risk goes way down. You make more money, your outlier risk goes down. So, does trade duration matter in the process? Well, for optimizing mechanics, the simple answer is yes. For theoretical edge, the answer is no. So what does that mean? Does trade duration matter? And that means if you do a trade that's 1 day out, 3 days out, 7 days out, 14 days out, 21 days out, or 45 days out, there is no difference in theoretical edge. You are going to have the same, let's call it penny around fair value in all those cases. There is no difference in theoretical edge. The difference is with optimization of mechanics, the difference is that you are at a better point in the decay curve when you give yourself different levels of mechanics. It's very hard to manage a trade with 1 day to go. It's very hard to manage a trade with 1 week to go. It is a lot easier to manage a trade with 45 days to go. And you live in a certain part of the decay curve, which is much more powerful for you over time. Also, duration matters because the deltas move slower, and hence you have fewer adjustments when you have longer durations. When you have short durations, delta moves really fast, and you have to make lots of different changes. When you have really longer durations, delta moves really slow. Both your gamma risk and your outlier risk are reduced. I wouldn't say they're reduced to nothing, but they're down. They become minimal if you add duration. And then adding duration, this is a cool thing. Adding duration synthetically increases implied volatility in the longer dated months. So if you're looking around and all the implied volatility underlying you really want to trade is low, you add duration to it and it synthetically increases the implied volatility. It's kind of crazy, but that's just the way the modeling works because nobody knows what's going to happen in the long term. So those options will have a tendency to stay higher. And if you look on the right-hand side of the page here, you can see with the 16 delta put, 53 days to go, the gamma is 0.93. And then the gamma risk goes up by 5x when you go down to three days to go. So there's 5 times less gamma risk from 3 days to 53 days. And that's just the whole argument here. You don't have to do everything at 45 or 50 or 60 or 30 or 40 days, whatever it is. But just understanding that having a diversified portfolio of underlyings, if you're trying to manage your portfolio, you're trying to manage all positions with 1, 3, and 7 day risk, man, you are not in for this. That's no party. But if you are managing positions that are all over the place, you could have a 3 day, you could have a 7 day, you could have 21 day, you could have a bunch of 45 days. It's a lot easier to manage those positions. And then how critical is timing? Because we know we can't time what the market's going to do. So what part of timing is critical? Well, your attention to what you're doing, that timing piece is critical. Your mechanics, your timing with respect to your mechanics, that's critical. What you can't do is time the market. What you can do is time the amount of attention you spend on something and time the amount of attention you spend to the mechanics. Timing is synonymous with risk reduction discipline, because if you want to be that risk disciplined person, okay, then you have to have this sense of timing, attention to all that stuff. Timing contributes to longevity. This is kind of a cool thing. Timing contributes to longevity, and longevity is the largest contributor to overall success. I do an entire speech on this, which I love to give about entrepreneurship. There is a minuscule difference between success on every single level in every single industry. There is not a huge difference between person number 1 on the depth chart and person number 100. Person number 100 has a lot of catching up to do, but most of it is based on your ability to survive. It's based on longevity. It's based on being able to hang around for 3, 4, 5 decades. It's based on being able to, there's almost no such thing as overnight success. And trading is the same thing. Trading, success in the investment world, success in the trading world, it's all about longevity. So your ability to be attentive, your ability to time the amount of time spent with respect to mechanics, your timing is synonymous with risk reduction and success. It's synonymous with longevity and overall success. Okay, and I'm going to go into the last piece here. This is called redeploying capital. So you have a position on. You have this entire portfolio. You've been managing it. You've been doing everything. We were talking about it in 3 different sections. You've been doing everything according to the book. Man, you're mechanical as hell now. But now what do you do? What's the next step? So how active should you be? Meaning, like how aggressive should I be? Well, be as active as you like. There's no such thing as being too active or too aggressive. There is such thing as not being active enough. But there's no such thing as being too active or too aggressive. Is there such thing as overtrading? I don't know. Maybe some people think I'm an overtrader, so it's hard for me to agree to that, but I'm also a very aggressive trader. So I like people that are active and aggressive. I'm fine with it. But some form of daily engagement, even if it's just a position review, some form of daily engagement where it's just like, hey, you know what? I just gonna check my positions. You don't even have to make a trade. But just, hey, I'm going to check my deltas. I'm going to check my P&L. I'm going to check my portfolio theta. I'm going to check my portfolio P&L. All right, what's going on today? Why am I losing this much money? Why am I making this much money? What's going on? I'm just going to check the futures really quick. You know what? Some form of daily engagement, I don't care where you are in the world. There's nowhere you can be in the world today where you can't do this. I mean, maybe, I don't know. Maybe on top of some mountain somewhere, who knows? But for the most part, there's almost nowhere you can be. And then monitoring markets or just talking shop is really valuable. One of the reasons that we do live events, one of the reasons we do this kind of event, one of the reasons we have chats, one of the reasons we do all this interaction on our network and everything else is because trading can be very lonely when you're sitting in a room by yourself or you're not around other people and all this kind of stuff. And investing is the same thing. Being able to talk shop at one of our live events or doing something like that is incredibly valuable. Being able to articulate your thoughts about trading, being able to talk to somebody else about markets. I do it all day long. I mean, I've been doing it all day long my whole life, so it seems like that's all I have to, at the Thanksgiving table, we always, or at some holiday table at my house, it's not a question of don't read your phone or don't watch TV. It's always like, hey, no talk, no market talk today. That's how wacky my family is. And then remember, and this is so important for me, product indifference and capital efficiency allow for more activity. If you're all locked up in equities, you're trapped like a rat. If you're all in certain commodities, you're trapped. You need to be in products that are you need to be in products that are some are capital efficient, more capital efficient than others. You need to be indifferent to product. The great thing about futures and futures options is they are almost all not correlated to equities except the indexes. They're almost all not correlated. That gives you all these other choices and all of them are capital efficient. So again, in your head, be agnostic, be product agnostic, be product indifferent, be strategically indifferent, be capital efficient. All of those allow for more activity. This is a correlation graph, and I put SPY, Qs, IWM, TLT, GLD, USO, UNG, and FXC. All of these have an underlying futures product. SPY is ES, Qs is NQ, IWM is RTY, TLT is ZB, GLD is GC, USO is CL, UNG is NG, and FXC is 6E. Okay, they all have a futures equivalent, and they're all the exact same. These are the ETFs that we use. And you can look on here and you can see that when you go to the bottom of the page and you take a look at, remember the SPY is the one across the board, and you look at bonds and gold and USO and UNG, you'll see that there's virtually no correlation. Fascinating when you start to look at all this stuff and you see kind of the beauty of non-correlation or uncorrelated markets. So how important is redeploying your capital and the number of occurrences? Well, in order for this stuff, everything we're talking about today, to be worthwhile for you, in order for everything that we're doing here to make sense for you in the long run, in order for it to work, in order for you to have some form of predictable outcome, you have to have a reasonable number of occurrences. So increasing the number of occurrences, the number of stuff you do something, whether you just log on, whether you adjust a position, whether you close something or reopen, whatever it is, the more occurrences you have to a reasonable number will allow for more predictable outcomes. Redeploying capital, taking your position, redeploying the capital, keeps your capital optimized. So again, basis reduction, high pop are the foundations of a successful portfolio that allow you to redeploy your capital, which optimizes your capital, which makes your results much more predictable. What you see on the right-hand side of the page is what happens when you create lots of outcomes. When you only have a couple, you can see at the bottom, it says number of trades sampled. When you only have between 0 and 200, there's girth there. There's lots of width. When you start to get down between 600, 800, or 1,000 trades, everything starts to narrow and there's very little outlier moves. When you get even more than that, 2,000 to 5,000 trades, it becomes a very narrow line. That's what this is all about. Creating occurrences allows for a more predictable outcome. Redeploying capital and keep your capital optimized gives you the capital to do what you need to do. And then again, it's all about basis reduction and high pot. So what are some reasonable return expectations? Because everybody asks me this all the time. So on your portfolio, what should you be? What's your objective? So the minimum objective, in my opinion, should be 3 times risk-free rates. Risk-free rates right now are about 5%. You are not going to do all this work for 6% or for 7% or for 8%. In my mind, with the amount of work that it takes, the resources and everything else, your objective doesn't mean you have to hit it, but your objective could be 7x, could be 35%. It could be 3% a month. If you have a smaller account, it's easier to hit higher numbers. But my point is, I don't care what it is, what the max is. I care what the min is. And the minimum of your objective should be around 3 times the risk-free rates. So we're talking, let's call it wrapped right around 15 to 18% on the minimum side, because that makes all this worth it. You should average approximately 25% of your daily theta, keeping it. So if your daily theta, let's give it back that example I used earlier, which was, let's say you had a $100,000 account, you had theta, which you collected $200 a day, which is 0.2%. And let's say there's 30 days in a month. Okay. So you collect $6,000 of theta. Then in that case, on $6,000 of theta, you're keeping 25% of it, which is $1,500. You then take your $1,500, okay, and you look at that and you say, okay, what is that on a monthly return? Well, lo and behold, that's 1.5%. That's 18% annualized. Just exactly where this is. See how beautiful that works, how the numbers work out? This should significantly, if you understand the math and the objective here, if you understand what managing a portfolio is and sticking to the mechanics and being disciplined and doing some things that sometimes are counterintuitive, but they stick to your discipline, and trusting the research and honoring that research, you should significantly improve all other aspects of investing. That means even for non-traditional investments and all other aspects of risk-taking and or business. Entrepreneurship, businesses, a lot of you own your own businesses, risk-taking and everything else. Like there should be 50,000 people, 100,000 people listening to this discussion today, because this is the kind of thing that changes lives. This is the kind of thing that makes a difference in everything else that you do. Just understanding, what is a reasonable objective? What's a minimum objective? How high could I shoot for? What is a reasonable amount of money to keep based on the risk that I'm taking? And how much will this impact everything else I do? It could be as much as 10x. Look at me. I thought I was done. Once you prove concept and you prove repeatability, what I'm talking about today here is very scalable. That goes back to that whole longevity thing. Forgot about how important this slide is. How scalable is trading an active portfolio? Well, you need to prove concept. Before you scale up, you need to prove concept. You need to prove that you can repeat this. Then it is very scalable. The general rule of thumb is scaling investments is about 10x the speed of wealth creation. I know that sounds like, just think about it, but I wrote this. We've kind of tried to come up with a model, but as a general rule of thumb, scaling investments is about 10 times the speed of wealth creation. Wealth creation takes a really long time. If you learn how to scale, you can speed that up 10x. There's a lot of studies on this, not just done by us, but there's some University of Chicago studies. There's lots of studies about studies on kind of economic foundation, economic bias, and all this kind of stuff, and about basically how scaling investments improves the speed of wealth creation, which is all what this is about. But again, first you have to prove concept. First you have to prove repeatability. Then it becomes scalable, and then you take things to another level.